You watch metals and markets every week, yet still shop with the big guys? Why pay more for your precious metals from the guys who have offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like Silver Shield and Heroes SD War Collection, to our exclusive new line of insurance approved TL rated precious metal safes, SD Bullion is what you're looking for at the lowest prices, period. Guaranteed! Because if you don't hold it, you don't own it. SD Bullion, founded by stackers to help you prepare for what's coming. Shop with the Doc today at sdbullion.com.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Well, we shared a big week this week, Eric, with the ECB announcing $60 billion a month in QE for the next several years, just a bit more than the market had expected at $50 billion a month. And really, it's been quite a week for gold and silver. Gold all the way through 1,300 until afternoon trading here on Friday. Looks like the cartel is successfully going to prevent a weekly close above 1,300, but still pretty strong, closing over 1,290. And silver actually is closing above 18 for the week here, really near the week's highs, closing around 1830 here in access market trading on Friday. It's been quite a week for the markets and quite a several week run for the metals here, Eric.
It has, yeah. The ECB's initial leak on Tuesday was really amusing to watch, and the trading afterwards. I don't know if most of our listeners caught that, but there was a news story that was fed to the Dow Jones News Service, and then it propagated throughout the rest of the world, where the executive committee of the ECB, the inner circle, said, we're going to do $50 billion. And this was after Goldman Sachs came out on last Friday saying, well, you know, the whisper numbers are at least $1 trillion of euros going for the QE program. And the very next day, on Wednesday, the euro actually appreciated by about 61%, or 61 cents, excuse me, against the dollar. And that was a clear indication that the market expectations were, hey, guys, you know, we really wanted to see something better than just 50 billion euros in a QE program. So, no surprise, surprise. And I should back up a step. When they actually made that leak and it was reported to the Dow Jones, the news was that, well, you know, this is the executive committee's perspective, and when the whole 21-member ECB board gets together on Thursday and makes their formal announcement, it actually might be more. So it was total market management exercises going, and it was really funny to see. And then as soon as the euro actually appreciated on Wednesday, sure enough, the next day, the ECB comes out with the bigger of the plan. They probably had, you know, two options on the table already formulated, and they pulled the bigger bazooka out because the market was telling the ECB that, hey, you know, we're not impressed with this garbage. I mean, speaking satirically, of course, or sarcastically. But, you know, here it is. We're on the other side, and again, the markets are not really super enthusiastic. It's kind of like ho-hum. These were roughly the expectations that we had before. So that just goes to show the diminishing returns that we see with these QE programs, and we've gone through multiple stages in all of these central bank QE programs, be it Bank of England, Japanese Bank, the ECB, and the Fed, and it's showing that the system is not responding as much to liquidity, and every time they do another QE program, it has to be bigger and bigger. And the speculation is now that at some point, I mean, most of the people who are in the Austrian School of Economics camp and Goldbug camp look out into the future and understand that the economic numbers have been completely managed. We had an unbelievably ridiculous example in the third quarter's 5% plus growth report, being over 2/3 driven by Obamacare-related expenditures that are pulling monies out of people's savings to pay for higher insurance premiums and so forth. And then the retail sales stinking in fourth quarter. So, it's clear that the U.S. economy slowing down, and that we've already had massive slowdown throughout the rest of the world, and this deflationary ball is gaining steam, rolling downhill and getting bigger and bigger. And at this point, it's pretty clear that the United States is going to have to do some kind of a QE program, and once the negative impacts from the bad debt in the oil sector and the burden that's existing with emerging markets and the debt that they issued in dollar-denominated terms comes home to roost. I'm expecting that sometime beginning in the earliest March time frame and moving through into the summer, that those forces are going to push so hard on the U.S. economy that the central bankers are going to start talking about the need to consider more QE. And Peter Schiff earlier in the week made it clear that he thinks that QE4 will be launched by the fourth quarter, and I think that's actually possible. Certainly, we are going to see a complete reversal in the jawboning that the Fed does, and their attempt to reset expectations to calm the market down. They've blown up this gigantic bubble in the credit markets, and stock market is at a bubble rate, and they're terrified of assets turning down and deflation taking over financial assets and then spilling over into the real economy. And I'm not in the camp where a lot of people are looking at February as being an inflection point along that slippery slope, and the main reason why is that the conventional world of finance is responsible for a very large amount of money, the majority of money. And right now, the kicking of the can exercise, as most recently executed with this ECB QE, has set expectations largely for the ability for this can kicking exercise to continue a bit longer. So I think people like Jim Willey have talked about February, and smartly so in the way he described it to you, actually, in his podcast that he did with you on Sunday. I was very impressed with the way he framed it. He said that February would be the time frame when things would start turning, but ultimately the downturn is something that you can't really predict and put a date on. And I think he had said something in passing like, I can't say the exact date. I mean, if it's June 15th or whatever, 2015, so be it. And I like hearing things like that because, as you know better than anybody, over the last 6 months or so, a lot of people have been kind of frustrated with pontification from pundits and whatnot, and people in the gold camp getting a lot of calls wrong. I'm not speaking about Jim Willing, just speaking generically. So, it's interesting how 2015 is shaping up. A lot of things are happening that are moving right now to set the stage for big changes later in the year, and we're definitely going to see huge volatility and the beginnings of road signs along the path of the dollar losing its reserve status that you and I have talked about on a lot of different shows. I think that the third quarter discussion at the IMF is going to lead to China taking on a portion of the SDR basket and reweighting of the voting shares at the IMF. And I should say, incidentally, just in passing, we don't have to talk a lot about it here, but I have talked a lot about it with Jason Barak's broadcast earlier in the week, and Rory Hall over at the Daily Coin and I actually recorded a show that was over 2 hours long. That'll be up over the weekend, and we talk a lot about these kind of things, so people can check that out. But the bottom line is that, there's this big debate in the precious metal space that it's either got to be China doing the SDR in that route and everyone thinking, no, Jim Rickards is a mouthpiece for the establishment pointing in that direction, or China is going to go her own way with the 24-plus bilateral currency relationships that she's set up and the development bank structures and all of these things leading to the path where ultimately China can flip the switch and become the world reserve currency of the world. And frankly, the debate actually misses the point that you can draw from what China's actions are on the ground. I mean, her policies and what she's been putting in place actually speak to a bilateral strategy, and that's very typical of what China does. They're supreme chess players, just as the Russians are, and they're setting up a path where they do both. It's not an either-or kind of scenario, and I want to throw this out here to the research community so that they can ponder it, because frankly I think that the debate about this whole, it's the FDR route or it's China doing her own route all by herself with the BRICS in tow and whatnot, it kind of misses the point. I think we're going to see China trying to balance a relationship with the West and at the same time be able to execute her own strategy governed by her own intentions. So with that, I think it's just going to be a very tumultuous year, and geopolitics is going to be insane. I mean, what's setting up now in the Middle East with respect to Syria is going to send shockwaves through the world. I mean, there's a scenario where we may even see U.S. and or NATO boots on the ground in Syria, because the situation is getting to the point where the plans of the West trying to destabilize the Assad regime to the point where it could possibly be taken over by ISIS moderates, quote-unquote, as the State Department likes to put it, is not a viable strategy anymore. They're getting their butts kicked, is the bottom line. I mean, they're expanding their territory in Iraq, and in some areas of the most eastern portion of Syria, that is true, but the actual strategic strongholds where Assad has the majority of Syria's economic interests and population concentrations and all of that in the western Mediterranean seaboard, and even in fact most recently the probability that he's going to retake Aleppo, the second largest city that has been dominated by these ISIS people, is all pointing to the fact that it's probable that we're going to see some kind of a stepped up action by NATO/America to try to change the strategy and get a little bit more aggressive there, because their plan isn't working. And last week we bird-dogged a couple of stories that were written by Timothy Alexander Guzman that we carried on to News Doctors that were just amazingly prescient. He put together some propaganda pieces that are coming out of Germany and Israel in their medias, pointing to the initial stepping stones of making the claim that Syria is developing weapons of mass destruction, specifically a nuclear program. And it just kind of echoes very strongly with some of the way in which the initial reports came out about Iraq. So, everyone has paid a lot of attention to Ukraine as being a flashpoint. And frankly, I think Syria is going to be in the headlines in the next 2 months in a pretty big way. So heads up, everybody. Read those Timothy Alexander Guzman stories. They're over on the News Doctors. You can click on his name button at the bottom over on the right side.
Let's shift back to the metals here for a bit here, Eric. Certainly it's been quite the month of January already for both gold and silver. Silver really is about $4 off of its lows, and gold is nearly $200 off of its lows. We were chatting a bit before the show, and we've talked in recent shows that we wouldn't be surprised to see a pullback here, and lo and behold, we're only a few days before next week's FOMC meeting, which traditionally over the past 3 to 4 years, probably 95% of the time, has been met with a pummeling of gold and silver on Wednesday afternoon and into Thursday, the day following the FOMC meeting. It's certainly shaping up as the potential to continue that here next week, don't you think, Eric?
Yeah, I think that's exactly what we are going to see. I talked about this with Roy back on Wednesday, the 21st, before the ECB came out with their news. You can see it in the trading yesterday. The mining shares kind of rolled over, and both silver and gold were having their own versions of capping come in. But, towards the end of the day, the metals actually did really well. They broke free of cartel suppression and started to rise again. But the action in the mining shares spoke to the fact that it probably was going to, be capped up pretty significantly today, and that's what we're seeing. You can also see in the 72-hour charts in both gold and silver, there's that telltale pattern where you can see periods of, an hour, 2 hours, maybe 3 sometimes, and not particularly strong this time around. I mean, we have seen occasions where the correlation between one day's trading versus the previous day trace at almost exact images of each other. I mean, that kind of pattern is the product of high-frequency trading algorithms being put in place where the programming is such that, just to describe it in simple English terms, it's, match the previous day but don't exceed it. And then during the course of time, as you move forward, you can see the pattern actually tracing an exact pattern of the previous day, or maybe the day before, or what have you. And when you look at the 72-hour charts, you can actually see that in the last couple of days going through the ECB's announcement. And then here we are on Friday, and people, a week ago would have probably thought, oh boy, ECB is going to announce a big fire hose of liquidity, so gold's going to take off. Well, here we are. The expectations are the setting up for momentum that was going into the metals in advance of that move, and then the cartel comes in and makes their effort to slow things down in this managed retreat process that we've talked about over and over and over again in many, many shows, precisely when the people who are interested in getting into the market on the expectation of the ECB's move were already in. And it makes it easier for the cartel to manage the price effort because they're not going after an oncoming train directly. They just kind of hit the market a little bit after the burst of interest of buyers come in. And so that's the pattern we've seen, and so it's setting up for what I've been describing all week, where we're going to see probably some capping and a downside move in association with FOMC. But the good news is that there's also clear indication that the physical markets are super tight, that there's interest in buying. If you look at the price of gold in particular in any currency around the world, with the exception of the Swiss franc, it's doing fantastically. I mean, in euro terms, gold is almost gone parabolic at this point in the last month or so. And in fact, I think that's going to slow down, actually, within the next week or so. Take a pause because the move has been spectacular. But China's still buying strongly, and all of the traditional places where central bankers have begun to step up their buying, they're also buying still. So the physical market is going to put a backstop to this very quickly. I don't expect to see much strong downside. We may see a spike associated with an aggressive effort one day before or one day after the 2 days that, in that 4-day window surrounding or encapsulating the FOMC meeting that's on Tuesday through Wednesday next week. The cartel might hit it really hard, but ultimately I don't think we're going to stay down for much longer. Maybe 1750 or whatever would be a bounce point for silver.
And options expiration won't help the cause either.
Yeah, that's true too. But the good news is that once you get past all this garbage and then go into February, it's just resetting the expectation table, and that's when we'll probably start moving back up again and resume the march in this ongoing bull market that's going to be pretty darn cool for all of the year. And I think it's going to be a shoo-in that we'll at least see 20-30% appreciation in gold based on January 1 to January 1 of next year, and the possibility of even a double or more. I mean, if some stuff that falls into place happens, then that could certainly come to pass. I mean, this is a bifurcated forecast, so to speak. I mean, I don't necessarily, I can't tell if the gold's going to double per se, but I think that it's, given that we've had this very long bear market already, given the vault supply that's been tapped and diminished that was used to suppress prices, particularly aggressively from April 12 through 15, 2013, all the way through the end of 2014, all of those factors and more that we've talked about ad nauseum on our show are such that we have very different conditions right now, even so strongly different that major deflation and all of the people who have this expectation that gold is not going to do well during deflation, they're going to be proven wrong. Gold is going to represent the ultimate money, and money always performs well during deflation. It's going to be considered better than cash, and silver is going to go along for the ride. Silver historically has had a mixed relationship with deflation and its relationship with gold, but this time around it's clearly going to follow gold because the level of debt overburden in our worldwide economic system, the risks associated with the derivative quagmire, all of these things are just so over the top and have no historical comparison in any time in history. And people are going to begin to start hedging because of these facts. Wall Street has stuck its head in its rear for the better part of this last decade, ignoring all this garbage, but it's just so bad now that even the conventional Wall Street types are beginning to look around and realize that this is where they need to be. They need to be in the precious metal space. It's going to take some time for that momentum to build. It'll build over the course of the year, and then at some point we'll have big catalysts where people will rush into the space. But for the time being, we're beginning to actually see the conventional Wall Street space, even though they're not talking about on Bloomberg and CNBC and all the typical venues, that quietly, I think money managers are paying more attention to gold now as a sober place to put a big portion of their money. So, well, I should not say big, but 5% or something is unusual for conventional Wall Street these days, and I think that's where a lot of people are going to be going when it comes to the conventional thinkers. And that'll have a big impact because it's probably only about 1.5% now on average.
Yeah, it certainly will. But if we do see really much of a decline, physical market will likely tighten up quite a bit again. Sales have remained strong, especially as silver has moved off of a 16 and up through 17. Sales, particularly for silver, have been very strong. The U.S. Mint already here by January 23rd has announced 4.7 million ounces of Silver Eagle sales. Now they have kind of leaked to the authorized dealers that beginning next week their allocations are going to be smaller than they have been for the first couple of weeks of January. So that'll be interesting to see. Especially if it coincides with a bit of a dip in prices, we could see some move in premiums. We may not see a new all-time sales record for January simply because the U.S. Mint reducing their output and their allocations that the primary dealers and the authorized purchasers can purchase. So we'll keep an eye on that. The Canadian Mint also continues to allocate silver maples as well. So silver market definitely remains strong on the retail side here in the U.S. Before we close the humor of the day here, well, I don't know if you want to call it humor or not, Eric, as the story over on Zero Hedge that George Soros conveniently exited the massive position he had short the franc just prior to the Swiss depegging the franc from the euro. So, as one of the Tyler Durdens sarcastically puts it, we can't help but marvel at the octogenarian's impeccable timing. He certainly has either impeccable timing or, much more likely, a few whispers of what's coming.
Yeah, either whispers are actually pushing the buttons of Mario.
Right.
And Swiss National Bank.
If you're on the Food Network and you cook, you go to prison for a few years for that. But if you're
unless you're a congressperson,
right?
Then you literally can trade based on information that you get out of Congress and do it
legal. It's illegal for Congress, of course.
No, actually, it is legal.
You're right. It is actually legal for Congress.
Yeah. Yeah. Pretty amazing.
Look up the law if you don't believe it. It's anyway,
one of the reasons why people go into Congress on average not being millionaires. The majority of the 535 members of Congress, but then they come out after one or two terms and net worth averaging $5 million, whatever. It's not just all of the great connections they get in business that they can execute because of their political pull, but it quite literally is their stock trading.
Certainly doesn't hurt to know it's coming before the market does and have it be legal. But
yeah.
Well, we'll wrap up this week's show there. We'll keep our eyes on the markets and gold and silver this coming week with options expiration, followed by the FOMC meeting Wednesday, and the likelihood for a takedown really Tuesday, Wednesday, and Thursday. So keep your eye on that, particularly with the big 1,300 level in gold, as the cartel would like to keep gold under 1,300 for options expiration. So wrap up this week's show there. So for the Doc and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Markets.
Those individuals who are in charge of monetary policy around the world, I think they're very much aware of what is coming. When I've asked Federal Reserve Chairman in the committee about this, they never said, no, that's not going to happen. They use the word orderly. As long as it's orderly, it seems to be okay.